The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hello, everyone. Welcome to the Tax Trailhead. My name is Spencer Rangel. I've been working at Larson since May of 2023. Before that, I was working at a firm called Eide Bailey. I worked there for about 2.5 years. And I am a tax senior associate here at Larson. Been doing tax for probably about 4 years now and just really enjoy it. And I have a co-host here. We have Derek here on the pod as well.
Yep, I'm Derek Bradley. I've been here at Larson for 5 years. I'm also a tax senior associate. I kind of specialize in small business tax matters, but I like it all. I like all the taxes. So happy to be here talking about it. And then lastly, running the show behind the scenes for us is Chandler Reed.
Hey guys, I'm Chandler Reed. Worked here at Larson for about 2 years. Also a senior tax associate. Worked in the tax industry now for about 5 years. So we're excited to bring you guys all some tax information.
Yeah, so going off of what Chandler just said, so the purpose of this podcast, really the Tax Trailhead, is really it's to help inform clients and also potential clients what's kind of going on in the tax world. What are the changes? What are the updates? Because there's just so many things there's so many moving parts, moving pieces, especially things that are happening behind the scenes, especially something that we're going to be talking about today that has been happening behind the scenes in Congress. And so we kind of just wanted to start this podcast for pretty much anyone who wants to listen and to learn and to know more about kind of the tax law and tax changes and updates. And today specifically, we're going to be talking about the Tax Relief for American Families and Workers Act of 2024. It's been going behind the scenes it's a bipartisan act or bill that's trying to be passed. And it's kind of just come up out of nowhere recently, and people just started talking about it a couple days ago, and we thought, what a perfect way to start our first podcast. But before we get into that, we just want to go over some important and key dates.
Yep. So coming up this year for the 2024 tax season, the IRS has set January 29th as the official first day for filing individual tax returns. January 16th has already passed, and that's the date for filing of business returns. So the 2023 tax filing season has already begun for our small businesses. Keep in mind that the due dates for the 2023 tax returns are April 15th for individuals and our proper C Corps, and for our flow-through entities, S Corps and partnerships, those due dates are going to be on March 15th, 2024.
Yeah, so just keep in mind those important dates. As that's not counting extensions. Extensions can also be filed, and there'll be 6 months extensions. But today we wanted to talk about, again, this American Families and Workers Act of 2024. We're going to kind of split it up into an individual section and a business section. We'll start with the individual section because this is what will probably impact most of the people either listening or pretty much most of the people in the U.S., at least those who have children, and that's the child tax credit, which was a pretty big thing for COVID. And I don't know if anyone remembers, but President Biden, I think for tax year 2021, he increased like the child tax credit to like $3,000 or something like that. And I think it was fully refundable too. And so
massive credit.
Yeah, it was huge. It helped a lot of people. And so they're kind of wanting to bring that back for this act. And so what it would do, it wouldn't go back to that significant of an increase, but it would increase. So under the current law, it's about $1,600. It's $1,600 per child. It would increase it for 2023 to $1,800. Then for 2024, it would be $1,900, and then for 2025, it would go up to $2,000 per child. It would also increase the refundable portion of the credit on a per child basis, which would increase the amount of refundability per child. So currently, right now, there's not a per child basis. It's just based on your net income, and then they take a ratio of it, and then that is your cap. However, now it would take that ratio and then multiply it by the amount of children you have, and that's the refundable portion of it. Of course, you can't get more of a refundable credit than the credit that you're supposed to be getting anyways. So if your like refundability is like $5,000, but your credit is only for $1,800 because you only have one child, let's just say, it's not going to give you $5,000. It's just going to give you that full $1,800.
Yeah, I think that this is great, and as you'll see with most of the rest of the changes that are in this bill, what they're really trying to do is save most of the taxpayers some money, or put money back in their pockets. I think that's if you could get a theme for what's going on with this proposal, it's that they're trying to lessen the tax burden for individuals and businesses, and this child tax credit is really going to apply pretty broadly and help out a lot. So,
yeah, which is, I think when COVID happened and they made those changes, especially this child tax credit, everyone loved it. Like it was, I remember even posting like, so I had a Snap. I don't use Snapchat anymore. I just don't. But I did have one in 2021, and I remember posting about it and just saying, should my wife and I have our first kid in 2021 so that we can get this $3,000 child tax credit? Just because I was like, this is such a huge increase. And so, I don't know, will more people have more kids because of this? Probably not, but it's just, I think a lot of people really enjoyed that.
Yep, it's fantastic. All right, so that's kind of where the individual portion, individual changes stop. So there's going to be a handful of business changes, and we'll jump into those now. So we're going to start off with Section 174 expenses. Now, these are expenses that are research and experimentation expenses that businesses may have, R&E. And currently, thanks to the Tax Cuts and Jobs Act of 2017, this phased in actually in the 2022 tax year, all Section 174 expenses had to be capitalized and amortized over 5 years for domestic expenses or 15 years for foreign. Now, this kind of jumped up on some taxpayers, so to speak, right, Spencer?
Oh yeah,
I mean,
100%.
There were people. It was one of those things that kind of got almost snuck into the Tax Cuts and Jobs Act, and we weren't really expecting it or planning on it to happen. And finally, in 2022, it turned on. It kicked on, and we had to start accounting for these 174 expenses.
Yeah, people really didn't think this was like actually going to happen. They were like, the bill passed, and people, saw that, and they're like, well, by then we'll renew it. We'll renew the bill, and we won't have to do this. And then
now it's done.
Yeah, and then it didn't get renewed. It didn't get renewed, and then time passed, and we've had to do it for 2 years now to amortize over 5 years and the 15 years for foreign. So I think it really caught people off guard that it never got renewed.
Absolutely. So, and it was actually such a point that, big time tax professionals and tax educators in the tax industry going into the last tax season were saying, hold off on filing these business returns because we're still anticipating that this will change.
Yeah.
Well, it didn't change, except for maybe it will now.
Yeah, they might do it now. This bill would essentially delay the date when you have to start amortizing to after December 31st, 2025. So starting January 1st, 2026 is when you would have to amortize over the 5 years. This bill doesn't change the foreign expenses. It just changes the domestic, which is still a big thing. And I think that would help a lot of people. The hard part is that we're going to have to amend 2021 and 2022 returns to now capture those previously capitalized expenses.
There is some discussion on whether or not that's gonna be the way that we have to go about it.
Oh,
They-
okay.
They may have a more simplified method for catching up on those capitalized expenses. One of the things I've heard discussed is they may just allow you to accelerate the remainder and catch up now in the current year.
That makes sense.
And hopefully they do come up with a simplified version, because actually it could be a fairly significant burden to have to amend, some of those prior year returns, especially you think of your large partnerships and with hundreds or thousands of partners, or any partnership under the new centralized audit regime.
Yeah.
They've got crazy rules, right? So
Yeah, and I even did a return here last year, and it was essentially 3 entities all being consolidated into one, and that was a pain, especially in the tax software. So to have to go through that and amend it, it would just be such a pain. So I think if they do that like a catch-up form or something for tax year 2023, that would be super nice.
yeah, fingers crossed.
Fingers crossed, yeah. And you might think, like, why did they even do that? Like, why would they make it to where... Because for, I don't know, since the 50s, I think, you've been able to expense R&E, these 174 expenses. Why would they change it now? A huge thing in the Tax Cuts and Jobs Act was it was a revenue raiser. They gave tax breaks in some areas like
Qualified.
QBI. They lowered the C corps from like 27% to 21%. So they were cutting these taxes here, but we need the revenue to back up those cuts. And so this was supposed to be a revenue raiser, which is why they did it in the first place. But now they know everyone hated it. No one wants to amortize this over 5 years. It's a very significant burden. So that's one of the things that's in this bill. Another thing is 100% bonus depreciation.
Oh, I love that bonus depreciation, baby.
It was so nice. For those who don't know, anything that any of your fixed assets that would qualify, essentially just personal property. There's specific rules dealing with automobiles, but to keep it simple, pretty much all personal property, anything that wasn't like a building.
All that 5, 7, 15-year life assets.
Exactly. All those computers, desks, furniture, all that stuff could just be 100% bonused in the year that you purchased it, which means you don't have to, you would still capitalize it, but on your tax return, you would just take the full deduction. You wouldn't have to expense it over the 5 years, the 7 years. But for 2023, for tax year 2023, the bonus depreciation is being decreased to 80% and being phased every year by 20%. This provision, though, would change to extend 100% bonus depreciation for tax years 2023 to 2025. And then, starting in tax year 2026, it'll go down to 80% and be phased. 20% after that.
Yeah, and along with this 100% bonus depreciation being decreased to 80%, you know what that was going to bring back? Section 179, everybody's favorite code section.
Yeah, we love 179.
We're kidding. We do not love 179. It complicates your tax filings a little bit. That being said, if you can bonus depreciate your asset up to 80%, in a lot of cases, you could get that remaining 20% through Section 179 deductions. It was going to increase and complicate our tax filings. Hopefully, if this bill actually passes, we'll be back to the 100% bonus, and we can delay our Section 179 worksheets and calculations for a few more years.
We can just keep cruising on of what we've been doing pretty much. So
that's right. Okay, so moving along, everybody's favorite 1099 NEC and 1099 miscellaneous reporting. So if anybody's ever done an odd job or won a drawing or an award of some sort,
or rental.
You got a rental, and that had a value of over $600. You may have gotten a 1099. The current rules are any business that wants to take a deduction for expense something, and they pay somebody over $600 or more, they are required by law to issue them a 1099. There are some exemptions and exceptions to that rule. You know, if the person you employed or whoever you had do the job for you was a C corp or a corporation, you don't have to give corporations 1099s. So there was an out there, but you still had to figure that out. You had to go get their W-9 and say, hey, who are you? What are you? I need to give you a 1099. And those have to be filed by January 31st each year. So that's a burden. And with inflation going up, $600.
Not that much.
Yeah, that's hitting a ton of people. But the new proposal in this bill is going to increase that threshold to $1,000 for the 2024 tax year.
Yeah, so starting in January of this year, essentially it would be $1,000. This isn't new. This $600 rule has been in here since the 1900s. I mean, I don't know when exactly, but I think it was like maybe the 1980s or something like that. There was a tax law that came out for the $600 rule, something like that.
Crazy, you know. You think about there's so many things in the tax code that are adjusted for inflation.
Yeah,
right. The standard deduction gets adjusted
every year.
Your Social Security gets adjusted, and there are other things as well, but not this $600.
Yeah, this $600 has pretty much stayed the same for decades, essentially. And this kind of goes along with, this isn't necessarily in the bill, but just as like a food for thought, the whole 1099K thing that like really got people antsy and anxious, third-party reporting, giving you a 1099, anything over $600, that was delayed for 2023, and so it's not in place in 2023, so you don't have to worry about that. For 2024, they're going to try to do like a transitionary period. I can't remember the exact threshold amount that they're going to do. Normally, if you have like more than, I don't know, 20,000 transactions or something, and if you make more than, I can't remember the numbers off the top of my head, like maybe 10 grand or 20 grand or something, then you would get a 1099K. I know a lot of people like got up in arms about that. Like, oh, the IRS is like going to crack down on the normal person for making money.
Yeah.
And it's like, yeah, I guess so, but like this $600 rule has been in place for so long, and if you make income, you have to report it. That's just like that's just the way it is.
Yeah.
This last topic that we kind of saved for the very end, we've pretty much hit on a lot of things that are going to be like what you would call maybe like a tax cut, right?
Yeah,
like
for sure.
Like you're giving out a lot of money for the child tax credit. You're letting people do 100% bonus. You're letting expenses, those 174 expenses, be expensed in the year they're incurred instead of amortized.
So no, those are all kind of like expenses to the government.
Exactly,
right?
exactly, right?
So what are they going to do?
Yeah.
How do they afford that?
Yeah, exactly. Like, where's the revenue? Like, how are they going to get money back? Well, I don't know if anyone has heard of ERC, but
oh man,
it's been huge.
The ERC is my bread and butter. I love it.
Yeah, it stands for the Employee Retention Tax Credit. It's the acronym is either ERTC or shortened ERC, Employee Retention Tax Credit. And so they're really going to be, the revenue raiser of this bill essentially is enforcement of this Employee Retention Tax Credit. There's been a lot of fraud. You've probably seen the TikTok videos of somebody saying, oh, if you had a business in 2020 to 2021 and you had employees, the government's just going to give you 20 grand.
You're going to get $26,000 per employee per quarter, and it's tax free too, by the way.
And most of them will just say, if you paid employees during COVID, you're eligible for this credit. Like, that's the only criteria.
This is all wrong. You should have, anytime anybody's saying you're getting free money, you should have serious alarm bells going off.
Major red flags. So there's quite a few. This bill, I would say half of it is those previous things we talked about, and then the rest is this. There was some other things in the bill that had to do with Taiwan, but we didn't really think that was super prevalent to most people who would be listening. But there is some stuff there, so if you want to read about it, about Taiwan, you can go there. But yeah, so we're going to be, for the remainder of this episode, we're just going to be talking about really what is the IRS, what is Congress, what is the federal government going to do with all of these ERC fraudulent claims. The first one, the first little subtopic we're going to go over is the penalty. So currently there's a $1,000 penalty that can be applied to a person who knows or has reason to know that there is an understatement of tax liability of another person. What essentially that means is if you know someone that essentially filed a fraudulent ERC claim, a 941 amended, there's a possible $1,000 penalty. That could be the person giving you the ERC, the people who are actually getting the ERC money. So that's what it is right now, which seems kind of low, because
it does seem low, but that's kind of interesting. There's a penalty for just if you are an individual and have knowledge about it, you're potentially subject to this penalty. That's kind of interesting.
Yeah, I thought that was interesting too. The way that at least that's how it's worded on the bill when I was reading the bill. That's how
I would expect in practice, that could be applied really broadly. I don't think it's going to be, it's one of those things. It has to be proof of the knowledge, right?
Yeah.
And so it's not like your Tom, Dick, and Harry out there are all going to be busted because their neighbor got an ERC.
Yeah.
Right?
Yeah. Exactly. Well, and I think a part of it is because the complexity of ERC. Like, how do you know, right?
Yeah. Okay.
So that's what it is now, but they're going to be changing it. They're going to increase the penalty for aiding and abetting this understatement of tax liability. When we say understatement of tax liability, it's essentially like the payroll taxes that you had to pay for these employee retentions. You would file to get that money back, right? And so an understatement of tax liability happens when you did it fraudulently. So you paid less tax than you should have. So it's an understatement of your tax liability. So whenever we talk about that, that's what that means. So the penalty for aiding and abetting the understatement of the tax liability by an ERC promoter will be to the greater, which I thought was interesting, greater of either $200,000 or $10,000 in the case of a natural person. Natural person was like the wording that they use in the bill.
So they're trying to say they're $200,000 if it's a business.
I think so.
$10,000 if it's an individual was a promoter.
Yeah, I think if it's just like yourself,
Yeah.
getting, I think that's what that means. Yeah.
Got it.
Or 75% of gross income of the ERTC or ERC promoter derived from providing the aid with respect to a return or claim of ERC refund.
Wow, that's fascinating. So they're saying if the promoter is found to be liable in this case,
Aiding and abetting.
and aiding and abetting, they're going to have to pay a minimum of $200,000
Yeah.
or 75% of their revenue associated with filing these fraudulent claims. And let me tell you, I've had my eye on a few of these promoter companies for the past couple of years because, number one, I don't want to go as far as to call them competition, but they're in our space and they've worked with some of our clients.
Well, some of them will even say, your CPA firm can't do this for you, which we take offense to.
That's
personally.
right. That a lot of these promoter firms have said, "Hey, your CPA doesn't know. They don't know this tax law. We know. We'll help you." Well,
Ding, red flags.
Your CPA knows you don't qualify.
Anyway,
And that's why.
there was a point in time when one of these local promoters here in Utah, I'm not going to name names here. They may be named in some other legit legal documents, but I'm not going to call them out here. But there was a point in time on their website where they were describing how much money they had claimed in ERC claims for businesses, and it was north of $2 billion at one point in time. And I happen to know what their fees were, and it was 15 to 20%. So I don't know. We could do some back of the napkin math and figure out what their revenues were, and it's several tens of millions of dollars, okay,
Yeah.
that they took, and so we know that their potential penalty, if they're found to be liable in this aiding and abetting of fraudulent claims, they're going to be owing millions and millions of dollars.
Yeah, it's huge. It's
Rightfully so. Rightfully so, in my opinion.
It's fraudulent. It's literally
it's
against
fraud.
the law.
It's fraud. So it's not. Yeah.
Exactly.
You know, we've used this term promoter a couple times in the language here. Could we maybe just go over, you know, what the IRS or, you know, Senate making this bill is defined as a promoter, just for everyone listening?
Yeah, so pretty much a promoter is any person who provides aid, assistance, or advice with respect to affidavits, refunds, claims, or other document relating to the ERC. If the person charges fees based on the amount of the credit or meets a gross receipt test. So they have to provide aid, assistance, advice with respect to this ERC. If they are fee-based, essentially if they charge a fee-based amount for the credits, so like what Derek was talking about, like 15 to 20%. If they don't do a fee-based, they might meet the definition of a promoter if they meet a gross receipt test. And the gross receipt test is just essentially, is a lot of your money made off of providing these ERC claims? And if so, then you are an ERC promoter, essentially. Yeah. So when we talk about promoter, that's just pretty much who they are. So that's the penalty
All right.
part.
So there is well, Spencer, how about you talk about the due diligence piece here?
Yeah. So due diligence, what does that even mean? So due diligence, I guess, when you think of due diligence, that pretty much just means like making sure you're doing things correctly, right?
Yeah.
So currently, paid tax preparers, so that would be like me, that would be Derek, Chandler, everyone here at Larson, well, I guess not everyone at Larson Company, but the tax department at Larson Company are paid tax preparers. We get paid to prepare taxes. We are subject to a $500 penalty for each failure to comply with the due diligence requirement that comes along with these ERC claims. This provision would also extend that due diligence requirement to comply with similar due diligence requirements. It would make the promoters have to comply to these due diligence requirements.
Oh, got it. So they're maybe not right now under current law considered to be paid tax preparers.
Exactly.
And so they wouldn't necessarily be subject to these penalties, but the bill is going to bring them in to our family of tax preparers for purposes of due diligence penalties.
Exactly. Yeah. So, and it also it increases the penalty from $500 to $1,000. Now, if a promoter does not comply, so if they don't do that due diligence requirement, they're then treated as knowing that their help resulted in an understatement of tax liability. Ding, we talked about that earlier, understatement of tax liability, and then would be subject to the penalty that we just previously talked about. So they would essentially, if they don't do that due diligence, they are now helping in the result of an understatement of tax liability, or they are more likely, filling that out or checking off that box of aiding and abetting of the understatement of tax liability, and now they can get hit with that huge penalty. So they would be on that $1,000 penalty for just a failure to comply with due diligence, and now they're leaving themselves open to this huge penalty of whatever's greater of the $200,000 or 75% of gross income. So this due diligence is it being added to promoters is huge.
That's great, and we've seen real life examples of this from these promoters who have, our clients somehow, they had a salesman knock on their door and say, hey, you qualify for an ERC, come get it done with us. Then eventually somewhere down the line, our client came to us and shared, hey, I got this employee retention credit. They should have called us along the way, but they didn't. And we immediately say, okay, well, we know quite a bit about this actually. Here are some of the rules. You had to have been subject to a full or partial suspension due to government order, or you had to meet these revenue decline tests in order to actually claim this credit. Can you show us what can you show us how you qualify? Can you give us some of that due diligence
Yeah.
on proving that you actually qualify to claim this credit? And they say, well, this promoter helped us. And we say, okay, well, we got on a phone call with the promoter saying, hey, can you give us some of this support for the validity of this claim? And they say, well, the client filled out this survey, and so that's how they qualify. And you know what? That's not going to cut it. These promoters, they created a really well-crafted survey that in their minds put all the liability on the taxpayer to self-certify that they qualify to claim this credit. But that is not doing your due diligence. You have to do a little bit of research to find out if there was a government order in place that qualified. You can't just say, yeah, look outside. COVID was happening. The supply chain was slow. You couldn't get goods. That doesn't cut it when it actually comes down to proving if you claim this credit. I'm really glad that they're bringing the due diligence into it. So, moving along, I think this is one piece. This next piece is another way where they're really thinking they're going to get some additional revenue as a part of this bill, and that's the changing of the deadlines. So the current law for claiming ERCs ultimately expires April 15th of 2025. Now, to note that April 15th, 2025 deadline is only for ERCs from 2021. So our 2020 ERC claims are set to expire April 15th, 2024, actually.
Okay.
And so if you had an ERC claim from a time period, and honestly, if people do have a legitimate claim, more of them are legitimately from 2020, okay? That's when there was a higher prevalence of government orders actually, suspending our operations around the country. When you started to get into 2021, the country was opening back up in most cases. So we were coming up on that deadline for 2020 credits this year, but this bill is proposing saying, hey, let's kill this thing now. There's been so much fraud. I've been in a few trainings where there have been people throwing around numbers where they suspect that as much as 90% of the claims out there are incorrect or fraudulent. Okay?
That is an insane number.
It is. But the thing is, when you make something this easy, anybody who has even a knack for doing something criminal, I mean, it's just like, it's almost a handout. So anyway, they're going to change this deadline to January 31st, 2024. And honestly, I'm in favor of this.
So that would be,
we've got
12 days?
We've got 12 days to get those claims in, people.
If this bill were to pass.
Yeah, and that's a good point, because let's say the bill doesn't pass before the end of the month. Are they still going to hold us to that say the bill passes February 15th instead or something like that. Are they going to, what about people who are filing claims after the 31st? I think there's got to be some actual technical, maybe they can just move this deadline to the date of the passing or something like that.
Yeah.
That being said, I'm wrapping up actually a couple of ERCs. So, I've been knocking the ERCs. We've done several legitimate ERC calculations and claims. They are out there. They're real. It's a good program. And once we saw that this bill was released and going, trying to get passed, we're trying to get things wrapped up here in the next couple days, get our stuff filed, because that should put some urgency under there. There's a chance this program, while it has all its problems, and whether or not I agree, even with my clients who, by the rules, can actually claim a credit, I don't know if they should have been, if I agree with the politics and the optics of giving out this money, if you can do it legally and lawfully, I think you should, and you should get the money if you can, but you got to do it now.
Yeah, they're wanting to pass this bill by the 29th.
Yeah.
They're trying to get this out before the tax season really starts, really ramps up.
And here's the thing, any one of the other tax savings for the people, that we talked about in the first part of this, any one of those might get changed or cut from this bill. I could see that happening. They might say, hey, you know what? We're not going to increase the child tax credit. Or, you know what? We're not going to bring back 100% bonus. Or we're not going to go ahead and let you expense all of your 174 expenses. They might change or adjust any one of those. I think if anything's likely to come through, it's this changing of the ERC deadline and associated penalties. And I heard an estimate that by changing the deadline to this January 31st, they're expecting to generate, I think I heard $70 billion in revenue just by that alone.
Interesting. Well, they're also changing the statute of limitations. So under current law, the statute of limitations is generally 5 years from the date of the claim. What does that mean? What does statute of limitations mean? That's the amount of time that the IRS has to audit your claim, essentially. And they're actually going to be increasing it to 6 years. So they're going to give the IRS a full extra year to potentially audit your claim, which I think they need it.
Yeah, they do.
There's just so much. The IRS is so constrained, budgetary wise, like monetary wise. They have been for years, and to give them extra time, especially with like your figure, the 90% amount, they need it.
Yeah, the volume of these claims, and it's really interesting on the reporting when you actually send in a 941X to claim a refund. You don't give a lot of information. You basically give them some numbers, and the IRS, assuming there's no actual errors on the form, basically is supposed to give you the money. And there's not a lot of ways for them to verify whether or not you actually were eligible to claim it. And so the only way to actually do it is to go and audit. And so I think what's going to happen is a really high majority. They might draw a number in the sand somewhere and say, hey, all credits over $150,000, we're going to have to go ahead and audit. And in order to do that, they're going to need the time.
Yeah, for sure.
Well, and this is a little off topic, and we won't get too far into it, but the IRS also recently announced a voluntary disclosure program for people that feel like maybe they were swindled into getting an ERC that now they think they don't qualify for. And one of the stipulations for returning that credit and kind of getting out of that penalty is disclosing the promoter that helped you file it. And so they're finding a way to get the information on these promoters, and I think that combined with extending this statute is them kind of sending a clear message. They're going to go after this. They're not going to let it by. And so
yeah, Chandler, I'm glad you brought that up. And you wrote a great blog post about that. You can find it on our website. But
which is larsco.com.
Larsco.com, LARSCO.com. The interesting thing about that voluntary disclosure program is, man, this is like, it's a little bit of a life raft, honestly, in my opinion, because so many people got swindled, got sold a bill of goods from these promoters. These were legit. They were like door-to-door salesmen. They were doing this, and
they were everywhere, too.
They were everywhere. I got in my car. I turned on sports talk radio. I'm getting ads for get your ERC.
I still get ads.
Still get them. I'm getting less, though. I think people are wising up. But regardless, it was out there. So I just want to jump back on that voluntary disclosure program. If you filed for an ERC and you weren't quite sure about it and you think something was wrong, number one, go ahead. You can contact us here at Larson. We'd be happy to look at it, tell you whether or not we think there's a valid claim. And if it turns out that you did not have a valid claim, you're actually getting a bone thrown to you here by the IRS. If you want to join this program and you say, hey, I didn't qualify, you're going to fill out the form. You're going to say who sold you on the ERC. You're going to, give the information to the IRS. You're going to pay back the credit, but guess what? you don't have to pay back the entire credit. You don't have to pay back 80%. So lucky you, you get to keep that 20%, and even though it wasn't valid.
And part of that's to cover for the fees you might have paid to that promoter, which are probably non-refundable at this point.
I would doubt that it's refundable.
Yeah.
Yeah, it's going to be hard to find these promoters in the Cayman Islands or wherever they're at now, right?
yeah. They're probably you do a business search and inactive.
That's right. Yep.
But another great advantage is if you do this voluntary disclosure program and you pay it back and you tick all the boxes that they want, none of those quarters that you did ERC is eligible to be audited after that. And so, you're basically, you're coming clean, you're showing them everything, and you're saying, I was with this promoter, I think it was wrong, I'm giving it back. Because what they're going to do is probably find all the claims filed by that promoter, and the ones that didn't participate, they're going to audit them. And some of them are probably correct, but a lot of them probably aren't. Like you guys said, 90% they think are fraudulent or incorrect.
And that's actually another good warning signal there, Chandler, is so you might think, okay, I got my money. You may not even have the cash anymore because, we tend to spend our cash. When we get a couple $100,000, we're probably not just going to leave it sitting in the bank. It's losing its value, right? But here's the thing. So you may not join the voluntary disclosure program, but somebody else who went to that same promoter is. And they're going to give them the name of the promoter. The IRS is eventually going to come, investigate this promoter, and then anybody who they touched is going to get audited. And then if you get audited, you're not only going to be paying back 100% of the credit that you claimed, you're also going to have to pay the associated penalties and interest that are going to continue to accrue in that time frame. So really, go ahead and pay that back if you think you got a incorrect claim there.
And they have installment plans on those payments as well. So even if you don't have the cash and you're worried about it, look into it. Try to do something.
Yep.
Yeah, that kind of ties in with this last point that we want to talk about. The very end of this bill talks about disclosures, how this bill is going to require ERC promoters to file return disclosures and provide a list of clients to the IRS upon request. So if this bill gets passed, and like we've been talking about, if the IRS goes back to those ERC promoters, they will now are legally required to give them the full list of their clients to the IRS. So now the IRS just has a full list of clients that they now can go, oh, we got this client A's, they filed for that to pay back 80%. We're going to go to ERC Promoter A. ERC Promoter A, what are all the clients that you did ERC refunds for? Oh, client B, C, D, and E. Okay, well now we're going to look at client B, C, D, and E's 941X's, and we're going to see if those were legitimate or not. So
yep,
there's a big paper trail. So pretty much just in summary, a lot of changes. Child tax credit, bonus, 174, 1099s, and the huge thing, the ERC. Just a lot of changes that are happening in the tax world.
Well, I think that's all we have for today. This has gone well as our first Tax Trailhead podcast. As you learn about some of these topics, if you find yourself needing some additional guidance, advice, tax help, you can reach out to your Larson representative. You can give us a phone call, 801-313-1900. You can send us an email. What's the email, Spencer?
Our podcast email is larsonpod@larsco.com. So it's Larson, LARSON, pod, POD, at larsco, LARSCO.com. That's our email. So that email actually goes out to all three of us. So you can send an email, we'll get it, and we'll maybe make a podcast our next one about whatever you say.
Yep. That's it.
Thanks for listening, everyone, and hope you have a good day.
See you out on the trailhead.